Welcome, I'm Jim. Today I want to share with you one of the greatest ways to make passive income, and that's selling options. Today I want to talk about what I think is one of the safest strategies out there, and that's the wheel strategy. I'm going to talk about how I do it differently than others. And at the very end of the video, so stay tuned to the very end, I'm going to share with you a number of completed trades I had back in October. I'm going to share why I chose those specific companies and how I did overall with each of those trades. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's go ahead and jump right in. I typically like to give a quick overview of what I think is going on with the markets and the economy. I do believe inflation is continuing to come down. A report came out today showing that inflation was a little lower in October than was originally expected. Not quite to the level that the Fed wants, but I don't think they're going to do any increase in December. I believe their next meeting is right around December 13th. So I think they're going to hold steady. And some of what I've seen out there is potential that they may start cuts sooner than expected. I still think they may have their first cut or two, probably in second quarter, and in maybe another one, like the first one, second quarter, and then the second one, third quarter. At least that's my expectations. Now, if the economy dives, they may do that sooner, meaning I do believe there's a lot of people out there hurting between the higher interest rates, both on home mortgages and credit cards, and personal loans has had an impact. And then all the student loans, a lot of the people who took out student loans are having to pay them again, and it is definitely having an impact. So what will be the impact on the market? I think we're going to continue to kind of go sideways. I do think we may get some kind of a Christmas rally. I'm not sure how big it's going to be since we've had a really good rally in November. I'm expecting that maybe a small rally, trending upwards, but mostly sideways. At least that's my 2 cents. And as always, it's probably only worth 2 cents. So let's jump in. This week, I want to go into a little more detail about my option wheel strategy and how I do it. And again, with any of my trades, I typically like to work with good companies, quality companies that are at good prices that I really want to own. I don't typically do trades on companies I don't want to own. The exception is IWM, which is the Russell 2000. I will do vertical put credit spreads on that or iron condors. For the most part, if I'm doing anything along the lines of cash secured puts or covered calls, I'm doing it on companies I want to own. And I think that's key at the very beginning is to pick companies that you really want to own and then pick a good price that you want to own them at. Now, it doesn't mean that sometimes things don't change and you might find, well, something has changed with that company. You no longer want to own it. So you don't just make the decision and never change your mind. You kind of reflect on that decision, especially if it gets into trouble, meaning it's in the money and you have to decide if you want to revisit, do you still want to own that company? Because that's key to everything. So once you've identified the underlying stock or the underlying ETF, what I typically do is with the wheel, again, I'm picking companies that are good prices, like bargain companies. I've had a lot of recent videos where I talk about companies that are at really good value. And then since they're at such a good value, I don't need to take it so much risk with them. I typically will do a 15 delta in my other accounts, but the accounts I'm running the wheel in, which is primarily at this time my Fidelity IRA account. And if you haven't heard about that one, that's when I shared that I rolled my 401k, which was I think over 20 years old, into an IRA so I could just sell options because I've been able to do better with selling options as well as buying stocks within that account versus just having it as a 401k. I won't go into detail about that. If you're curious, check out last week's video, and it talks a little bit more about that in detail. So I pick a higher delta, usually a 30, 35 delta versus a 15 delta, which allows me to bring in a lot more cash on the front end. And then I'm still getting a better price, but between the better price, say it's a $115 stock, I may get the stock or the strike might be around 110, but then I'm bringing in maybe $2 or $3 in cash, which puts me in around 110, 112. And if it's already a bargain, that's typically right around its 52-week low, if not lower. And I typically do that with the idea that the first step of the wheel is selling a put, a cash secured put. And by doing it at that level, I can also later on sell a covered call when it gets assigned to me. And that covered call, I also want it to have a lot of premium too. And so most of my trades I've already looked at, and I realized, wow, there's some really good covered call premium as well as the cash secured put. Let me take a step back real quick. If you're new to what the wheel strategy is, it's just selling a cash secured put, which selling a put is someone wants to have the opportunity to sell you some shares, and they'll pay you for that opportunity. So if there's a stock that's like 110 and I want to own it at 1.5, I can sell a put and someone will pay me some money for the opportunity to sell me those shares. So once I sell that cash secured put, and the reason it's called cash secured put is I have enough cash to cover those shares when and if they get assigned to me. And then once they are assigned to me, then they'll be put into my account. And then at that point, I can sell a covered call. And since I'm doing it in a retirement account, I'm not so worried about taxes. I can take more risks. I can actually sell that covered call again at a much higher delta than I typically would do. And then what'll happen at that point is it'll be assigned away from me, just like with a put or similar to a put. A covered call or selling a call is someone wants the opportunity to buy those shares from you at a certain price, and they'll pay you for that opportunity. So that's what a covered call is. And it's covered again because you own those shares. So just by the nature of it, it's less risky. So again, with taking a little bit more risk, I can pick up a lot more money with the premium from that selling that covered call. Again, another for instance. So maybe the stock's at 115. I sell a 110 strike for the put. I bring in $3, and then I do the corresponding call. Well, that may also bring another $2 or $3, and then suddenly I've got $5 or $6 worth of premium, which is like $500 or $600. And I'm able to do this trade in a month or two and can make some really good profit from that. I also like to look at not going out farther than 90 days. In the past, you probably watched some of my videos. In my normal accounts, where mostly they're invested, I don't have a whole lot of cash. I will go farther out. I'll go as far as 6 months out, especially with calls, and sometimes 3 or 4 months out with puts. But now with running the wheel, I try not to go any more than 90 days out. So no, I prefer closer to 45 days. That way I can spin the wheel a little quicker and make a little bit more money. And again, that just by nature of it garners higher premium, so I can make more money with my trades. And you'll see that when I show you at the very end of the video, when I go over the specific trades I did in October in my Fidelity account. And these are completed trades, so I did not roll them. I either closed them, they expired, or I had in one instance a particular stock was assigned to me. And you'll get a better picture of what I'm talking about when we look at those actual trades. And then also these are really, or this strategy is really good for retirement accounts or accounts that you're not being taxed on, because you can keep running the trade. If you did this in a regular brokerage, you'd have a lot more capital gains. So it really lends itself nicely to doing it in IRAs, Roth IRAs, SEP accounts. If you have a small business, your 401k, and you can really increase your returns. I'm finding, in my Fidelity IRA, I can almost get something like on a yearly basis 16, 17, maybe as much as 18% return in 1 year. And this is doing safe strategies on good stocks that I really want to own and will end up owning. So one drawback sometimes though with it is, and this happened last year, if I don't take enough risk, I might miss some great opportunities. And I had that last year. So, maybe if I'm still not owning these shares, meaning they're not being assigned to me, I might take even more risk and bring in even more cash. Because last year I had the opportunity to own Apple. I think it was around 120, 130. I had an opportunity to own Google around 100. And I missed those opportunities because I didn't take enough risk and I kind of rolled out of some really good opportunities. And I'll talk about that a little bit when I go over my trades too. So, so that's it. That's the primary thing I wanted to talk about before I share the trades. As always, please subscribe, hit that like button. If you're curious about my memberships, details will be below. If you want to look at Seeking Alpha, I also have details about it. They are having they're still running their, what is it, Black Friday sale. So all those kind of details will be there. I encourage you to look at the membership. At some point, I probably will increase prices and change my tiers, but I'm getting a lot of interest and we're having some really good discussions. So I encourage you to take a look. It may be well worth your while. So that being said, let's jump into the next part of the video. Now I've opened this new spreadsheet that I created. If you're familiar with my channel, I seem to come up with spreadsheets. I end up borrowing a lot from other spreadsheets and just making modifications. But this is based on my new IRA, which is in my Fidelity account. And these are all trades that I did in October. A lot of them I did close or they expired in November. But we'll just kind of jump right through it. At the very top, I've got what the account value was when I moved my funds over from my 401k, and it was 217,827. Here are my weekly goals. My hope is to make 600 weekly, 2,400 monthly, which comes out to be 1.1% on a monthly basis. And so far, I've been able to exceed that. I think this month for November, I'm right around 2,400. I might be 2,300. But last month, I did 3,700. Now, a lot of people might get aggravated when I say I made that much, but that's premium that I brought in. So some of those trades have not been closed yet. All the ones I'm going to share here have been closed, either through expiration, closing them by paying a little bit to close them, or they've been assigned, and only one has been assigned of these, I believe, 11 trades. So the steps I took is I rolled the 401k to an IRA within Fidelity, and I literally called them, and within a couple of days, they had rolled it into a new IRA, and they worked with me directly over the phone to set up where I could do the trading I wanted to do in the particular account. And now I'm trying to fund the entire account or invest the entire account. But at some point, I want this to resemble most of my other accounts, where I own quite a bit of stocks and I'm doing covered calls. And I'm definitely not there yet. Another reason I did decide to do this is Fidelity pays really good interest rate. I believe it's right around 5%. I might even be able to do a little bit higher. I think there is a different fund I might be able to switch to that pays a little bit higher, but currently it's paying 4.99%. And this was my first payment. I did get it at the beginning of November based on a partial month of October. I brought in $845, which when I did the calculation, that does equate to the 4.99%. Also up here, I was talking about how I wanted to fund the account. I want 20% to be in SCHD, 40% in different ETFs, and then finally another 40% in other stocks. So just kind of an overview. And I have similar spreadsheets for each month like this that have all the different trades. So again, these are the trades that have been completed. So one of the first trades I made was selling a put on SCHD, and that one is expired. It expired, I believe the Friday was 11/17, so the date 11/20 is because it expired on that Friday. Yeah, here's the expiration, 11/17. And SCHD is one of my favorite ETFs, pays a good dividend. I think the dividend's like 3.6 or 3.7%. I brought $310 in premium. This is the margin, so it's just literally the value of SCHD, and I believe this was one contract minus the 310, and the yearly return on investment was 18.83. So that would mean I'd have to do that literally about every month or more often, but it's a good way to measure how you're doing with these trades. Another one is IJR. This is an S&P 500 core group of companies. I like it better than IWM, even though I trade IWM a little bit more. I want to own IJR. I've owned it for many years and I've done quite well with it. So this one, the original trade date was the 18th. It also expired. It was also a cash secured put. It looked like SCHD was 2 contracts, and so is IJR. It was also 2 contracts. And you can see also the delta, nearly a 35 delta here. And I did it at a 90 strike. At the time, it was 92.31. I brought in $264 for the 2 contracts. And it also was right around an 18% return. Again, this is the 90 times 200 minus 264.70 is how I came up with this. And this is just based on these two allocated on a yearly basis. So 2 of the ETFs that I shared up above. And then next is Corning. This is the only one that got assigned. It was a cash secured put at 29. At the time, it was 29.50, so it went lower. I believe it went down to 28. And I had brought in $192 on the 2 contracts. So, it lowered the price about $1. So instead of 29, I own Corning in this account at more like 28. But this was just based on the premium. So in this case, it would have been like almost 32%. But now since I own these at closer to 28 is what it's showing in my account. And I believe it's a little bit higher than that. So I do have a small profit. But now Corning pays over a 4% dividend too. And I think long term it's going to be a great investment. Next is Qualcomm, another company I really like. It got hit earlier, I think in October. It wasn't near its 52-week low, but it was at a really good price, great premium for a fair price. And since then, it's gone up considerably. So it was at 108.90. I did 95.85. I did a vertical put credit spread. Now you might be wondering, why am I doing a vertical put credit spread? Well, the main reason is the $85 put was so cheap, it just made sense for me to buy it. If I can buy a put cheap, I'm going to do it. And I typically will do a $10 spread. And that's just worked for me. I've had some people that prefer 5. Sometimes I'll do a $7.50 spread or a $5 spread. But I really like the $10 spread. Like I said, most of my trades have worked out well with it. So at the time, it was expiration of 12/15. I closed it on 11/20, so I closed it early. And this is one of my most profitable. So I brought in 215. This is based on the $10 spread minus the 215. And the return was $115 because I didn't hold it for very long. I held it for less than 2 months. So that's why that return, that's probably one of my best returns, or it is. It's the second best return. EMN, which is a chemical company. Now, it's struggled a little bit more. This one, I did close it for a nice profit. At the time, it was 73.31 when I made the trade. It was going to expire on 12/15. 204 I brought in. This was a cash secured put, so it was a 33% return. And since then, I think it's gone, it may be like 71 or 72, so I can definitely look at writing another one of these. Home Depot, now since I did this, Home Depot has shot through the roof. I believe it might be over 320 now. So I did this at 10.20. I closed it on 11.20. It was very, very profitable, over 90%. The strike was 260, expiration 12/15. It was 285. I brought in $393. So, I mean, premium for Home Depot is really, really good. And then this was for 1 contract. So this is the 260 times 100 minus this 393. And it was for on a yearly basis, almost an 18% return. So you can see how much cash was brought in, and that's colored green because it's so much cash. I hope to do another one with Home Depot, but like I said, it shot through the roof. It had good earnings, and I think it's like 320, 330. So it's not quite as a good value as it was before. AMD, another good company. I did this trade towards the end of October. I closed it, or it expired 11/20, so it was a short trade. It expired on 11/17, so a little less than a month. At the time, it was 96.35, just like Home Depot. That AMD has also gone way up. maybe over 120. I don't know exactly what price it was, but I brought in 236. This was also a vertical put credit spread. Again, the main reason I bought the put, which was 75, is if it's cheaper than about $20 per contract, I typically will buy it. This is for 2 contracts. And again, this is 2,000, the $10 spread minus the 236. And then since it was such a short period of time, I had a 212% return based again on the spread value. So I'm looking to do another trade with AMD. It was coming down a little bit today, but if it ever gets anywhere near $100, I definitely will do another one. Best Buy, I've been selling options on Best Buy a long time. It's been in and out of the money recently, but I still don't own any, and I definitely want to own some. So strong company, pays really good dividend, and increases those dividends. I made this trade back early, the 1st of November, closed it at the end of November. It was a cash secured put at 62.50. It was 1 contract, and I brought in $218. So here's again the required capital. So it's the strike price times 100 minus the 218.35. It was a 48% return. And again, every one of these I closed were probably over 85% profitable. Okay, this is BKE, another company I really like. Great company, no debt. Literally no debt, 0 debt. They've been hit a little bit hard recently because of the economy slowing down. Their stores aren't as profitable, but I think that'll turn around long term with having no debt. Once we do come out of a recession, I think they're going to do really well, and they pay a really nice variable dividend. They do usually once a year, and it can be almost as double what the current dividend is. I did this with a little bit more risk, almost a 40 delta. At the time, it was at 33.15, so I did a 32.50 when the current stock price was 33.15. I brought in 278. Here's the required capital, and it's almost like a 58% return. And you can see I just literally closed these recently. Next is IWM, and this is the only company or ETF I don't want to own. I typically just do these trades to make extra income, and these were also vertical put credit spreads. And early in October, IWM got below one. It got into the low 160s, so these became very profitable. It's now over 180. This was an 18 delta, so I could have probably taken even more risk. And I brought in, at the time it was $170. I brought in almost $200, $199.92. And again, here's the required capital, and it's 72% return. So, and then finally Zoom, and Zoom's another one just like Best Buy that I've sold lots and lots of vertical put credit spreads on it. And I currently still do not own any Zoom, so I need to fix that because their call premium is really good. So I'll probably do another Zoom trade and probably take a little bit more risk, so I hopefully do get assigned. I do want to own them. They have also, like BKE, they have no debt. They have a really good amount of cash. I'm wondering if they're going to start paying dividends at some point. But I didn't take a whole lot of risk with this. This was also a 17 delta. And this is kind of old habits die hard. The 55.45 have been my favorite 2 strikes that I've done with this. And you can see I did the trade on 10.9, closed it on 11.28, which is a little bit early. At the time, it was at 64.70. I believe it's like $68 now, so it's also gone up. Brought again another $200. The required capital was $17.98, and this was like an 81% return, almost 82. And then if we come to the very bottom, the premiums for all of these were $27.15. The income I brought into the account was $8.45 that I talked about earlier, and then the total was $35.60, which equates to a 0.82 on average for a 2-month period, which is almost 10, just shy of 10%. And these are just a small portion of, I've got another 12 or 13 trades. All of but 1 or 2 are fairly outside the money, so I can probably close them. Most of them will be closing December 15th or January, I think it's January 19th, which is the other monthly option close. So this, so far from what I've gathered, it's almost, I'm doing close to 14% on, or 15%, not including the income that I'm bringing in. So you can do quite well. So, during a rough year, not really a rough year, but if you weren't investing in the Nifty 7 is what I like to call them, the Google, Microsoft, Nvidia, that whole crew, you typically had almost a flat year. But with this premium, with the income, it's almost like you can get a 15-16% yearly return. So that's it. That's what I wanted to share. These were the different trades, that I did. I'm still trying to do one trade a day, and like I said, I've been able to reach this monthly goal. This month, I believe in November, I'm at 2,300 just for premium, and last month I think it was closer to 3,700. So, as always, if you have any questions, comments, concerns, or if I missed something, please leave a comment. I typically try to respond to all my comments. And thanks for joining me, and I look forward to seeing you next week.